In this lecture, I want to show you how you can avoid having this unlimited loss profile. Now, this is a spread, and what we're seeing here is a single option, but the way you avoid the unlimited loss profile is to convert this single option into a spread. So bear in mind you're selling this option, and whenever you're selling options, you have to adopt the mindset of the insurance company. So if you look at the insurance company, if you compare this profit and loss graph, this is what an insurance company's profit and loss graph would look like. When we paid $1,000 for our car insurance, that is the maximum that the insurance company could make in that transaction. However, if the value of the car went down to zero, then they were facing a huge loss. They were facing a $20,000 loss. And you can just imagine if you, instead of a car, if it was a house, then you're perhaps paying a couple of thousand per year on insurance. And if the value of your house is about $1 million and something happens to it, then the insurance company is on the hook for that amount. So their reward is very less and their risks are very high. So you might be thinking again, so why, what is the catch here? Why would you want to be a seller? Well, again, I think we've not touched on the concept of probability yet, and that's coming when we do the Greeks and when we talk of delta and all of that. But the point is that when you assume the role of an insurance company, you're playing a probability game, and we'll understand that aspect a lot more as we go along. The insurance company is obviously facing a huge loss, so they have to be a financially strong company to take up risks like these. Similarly, the broker also wants enough margin so that this position, if at all it goes against you, the broker can be sure that you have the funds for it. And that's why whenever you do a naked sell like this option, you're going to see that the broker is going to hold a whole lot of margin. But we saw in the call options, we don't have to really be worried too much about this kind of a scenario because we can always do it as a spread. And I'm just going to show you the concept here again. We're not going to, the spreads take a long time before you can get there. So if you're just starting out in options, spreads are at the very least about 6 to 7 months away. So, but at least you can have an idea that what would you do, if you wanted to be a seller of options, because selling options is a very, very viable strategy. And I'll show you that quickly here. What we do is let's go back to our option chain, and instead of the 470, which is very close to where Apple is trading, I want to take a out of the money put option. Okay, so we want to sell, let's say, the 425. So instead of 470, I'm going to change this to 425. And what I'm doing here is I want to show you the concept of probability. So just a little peek into it. So here we are, Apple's trading at 467. Now, our short strike price, now this is called a short option because we've sold it. It's not short like we want the market to go down. That's different terminology when you're talking about stocks. When we talk about options and you say you're short, that means you've sold an option. It could be a put option, it could be a call option. It doesn't matter. And when you're long an option, you've bought the option. So it could be again a long call or a long put. In this case, what we have here is a short because we've sold, and it's a put option. So this is a short put. So what we did was we sold the 425, which is right here, and Apple is trading right here. So you can see now, we've put so much probability on our side. So we have all this room here for Apple to move in the next 30 days. And we'll still make a maximum profit. If you were the seller of this option, you would still make your maximum profit if Apple was anywhere above 425. Now, if Apple goes up, then you don't have to worry at all because you have your max profit at in any of this range here. So you can see that now you're putting probability on your side. So here is where the construction of your strategy becomes important, because you can put probability on your side and say, okay, if Apple doesn't come below 422, then my option is going to be profitable. And so you can construct these kind of strategies with options. But now coming back to our original issue, we wanted to construct a naked sell. This is what that is. And you can see the brokers holding 51,000. Now, why is the margin less here? Because we've moved the strike from 465 all the way down to 425. So now our risk is much less because we've increased the zone where we can profit. So the broker realizes that all these platforms are programmed for these kind of things, and they immediately hold less margin. But let's say even this is quite a big margin. So, if you didn't want to put $51,000 as margin, what we want to do is something very similar that we did in the call options course. So here we have maximum loss, or we have an unlimited loss profile on the downside. So if Apple goes down, we have an unlimited loss profile. We have our short put here at 425. So what we want to do is perhaps limit our unlimited loss profile at maybe 420 or 415 or 410. So in that case, what we would do is we would buy one of these options. Here we've sold the 10 contracts of the 425. Now what we want to do is buy, let's say, 10 contracts of the 420. So if we put that order into the order ticket, then we have a spread. So this is called a bull put spread, and if you look at the risk profile now your maximum loss is capped. It doesn't matter how much Apple falls, your maximum loss is going to be 4,540. And immediately look what happens to your margin. It came down from $51,000 all the way down to 4,540. So this is how you would construct a spread. You still have all this room, and you still have your short strike is at 425. So you're still maintaining all this room and all this probability to succeed, but all you've done is you've given up a little bit of your max profit. In return, you've got a loss profile that is capped. Now we'll be dealing with spreads in detail in a following course. So there are 4 spreads, and we'll look at all 4 spreads. We'll probably split it up into two courses, in credit spreads and debit spreads, and we'll look at all of these in detail there. So this is as far as the put options course is concerned. I do want to just throw in one more lecture after this, because we've now seen a call option, we've seen a put option, and you have a buyer of a call option, you have a seller of a call option, you have a buyer of a put option, and you have a seller of a put option. So you really have 4 different strategies here, and all 4 of these strategies fit into a box. And what I want to show you is that box in the next lecture. It'll be a quick lecture, but I want to show you how these 4 strategies stack up against one another. So I'll see you in that one.